Welcome to our deep dive into a company that has been making significant waves in the microcap space, SBC Exports Ltd. Traded under the symbol SBC Exports on the NSE, this company is not just a textile player, it is a unique conglomerate blending garment manufacturing with IT services and logistics. As we look toward 2026, many investors are asking, is this the next multi-bagger for a long-term portfolio? Today, we will analyze the fundamental shifts, the financial trajectory, and the market sentiment surrounding this stock. Whether you are a seasoned investor or an aspiring entrepreneur, understanding how a small company scales into a diversified powerhouse is crucial for wealth management. Let's break down the numbers and the strategy that could define its value over the next 2 years. What sets SBC Exports apart is its triple-engine growth model. First, we have the core Garment Exports division, which focuses on high-quality apparel for domestic and international markets. Second, and perhaps more exciting for growth investors, is their IT and e-governance division. This segment leverages government portals like GEM to provide manpower and IT solutions. Finally, their tour and travel segment adds a layer of service-based revenue. By 2026, the company intends to shift its revenue mix more heavily toward high-margin IT services. This diversification acts as a hedge. When the textile industry faces raw material volatility, the steady service contracts from e-governance provide a stable cash flow. Understanding this synergy is key to evaluating their risk-adjusted returns. Let's talk numbers. SBC Exports has shown a remarkable revenue CAGR of over 40% in the last few years. As of our latest analysis, the company is maintaining a healthy EBITDA margin, which they aim to expand as the IT segment scales. For the 2026 outlook, we are looking at a projected revenue target that could potentially double from 2023 levels if the order execution stays on track. Currently, the stock is trading at a PE ratio that suggests the market is starting to price in this growth. With a market capitalization of approximately 600 crores, it remains in the microcap territory, offering high-risk, high-reward potential. The debt-to-equity ratio remains manageable, which is a green flag for conservative investors looking at small-cap stability. The biggest driver for SBC Exports stock price through 2026 is likely their dominance on the GEM, or Government e-Marketplace portal. They have successfully secured contracts with major entities like the UP government and various central departments. These are not just one-off deals, they are recurring service contracts for manpower and technical support. By 2026, the company plans to bid for larger, more complex IT projects. This transition from a manpower provider to a full-scale IT solutions provider could lead to a significant valuation re-rating. In the world of finance, quality of earnings matters, and long-term government contracts provide a predictability that most textile companies simply don't have. This is the cornerstone of our optimistic 2026 outlook. Looking at the stock chart, SBC Exports has been a consistent performer, often outperforming the Nifty Small Cap Index. As we analyze the 2026 horizon, the technical indicators suggest a pattern of higher highs and higher lows. The stock recently underwent a split and bonus issues, which improved liquidity, a vital factor for retail investors. Our 2026 price target analysis considers a base case of 60 rupees and a bull case of 80 rupees, provided the company hits its IT revenue targets. However, investors must watch the support levels around 25 to 28 rupees. For wealth management, the strategy here isn't timing the bottom, but accumulating during consolidation phases. The stock's volatility is high, so a disciplined approach is mandatory. No investment is without risk, especially in the microcap segment. For SBC Exports, the primary risk is client concentration. A large portion of their revenue comes from government contracts. Any change in government policy or procurement norms could impact their top line. Secondly, the government business is highly sensitive to cotton price fluctuations, which can squeeze margins. Third, as they scale their IT business, they will face stiff competition from established mid-cap IT firms. Investors should monitor the quarterly operating margins closely. If margins dip below 10%, it could be a sign that the company is struggling with rising operational costs. Diligence in tracking these metrics is what separates a professional investor from a speculator. As we look toward 2026, the company is not sitting idle. They are expanding their manufacturing units and investing in automation to lower production costs. In the IT segment, they are diversifying into software development and digital transformation services. This shift is expected to improve the return on equity, ROE, from current levels to over 20% by the end of the 2026 fiscal year. Management has also hinted at exploring international IT markets, which could be a massive game changer. For an investor, the story of SBC Exports is about evolution. They are evolving from a labor-intensive model to a tech-enabled growth model. This transition, if successful, will likely lead to a much higher PE multiple than the textile industry average. To wrap up our analysis of SBC Exports Ltd for 2026, the outlook remains cautiously optimistic. The company has the right ingredients: diversification, government backing, and a clear path towards high-margin services. For investors, the strategy should be buy on dips. Don't chase the stock during vertical rallies. Instead, look for periods of consolidation. Diversify your portfolio. While SBC Exports has multi-bagger potential, it should be a part of a balanced investment plan, not the whole plan. Keep a close eye on their quarterly results, specifically the growth in the IT service segment. Thank you for joining us in this analysis. If you found this helpful, subscribe for more deep dives into the Indian stock market. Happy investing!